Hi guys, do you dream of trading like the big shots on Wall Street and making serious cash in the market? Or are you happy being a retail trader keeping things simple? If you're eager to dive into trading like the big leagues, then you're in for a treat. Stick around because I'm about to share a killer strategy that smart traders swear by. It's called supply and demand. So what's the deal with supply and demand? Think of them as the hotspots where the market's big players like institutional traders do their buying and selling. If you can spot these areas, you can ride the same waves as these pros and even predict where the market's headed before it gets there. Now, let's talk about finding these supply and demand zones. There are four main types. Let's start with the first one, the drop base rally. This one's like a roller coaster. It starts with a drop, a small downward move showing weak momentum. Then a pause called the base, where the market hangs out and gathers its strength before shooting back up. When the market revisits this base, which we call a demand zone, there's a high chance it'll soar up again. Check out this chart to see it in action. The market experienced a downward movement, followed by a brief consolidation and then another upward surge. When the market retraced back to test this zone, it rallied strongly. So why does the price tend to rise again when it retraces to this demand zone? The answer is simple. This zone is where institutional traders initiated their long positions. After taking profits, the market retraced, and they anticipated its return to this zone because it's considered an attractive entry point for long positions. When the market revisits this zone, these traders enter long positions again, resulting in a strong upward movement. Understanding how to identify this zone enables you to trade alongside major players, comprehending the rationale behind the trade and its success. Here's another example. Here, you can clearly observe a distinct drop base rally demand zone pattern. The market declined, paused momentarily, and then surged strongly, forming what we refer to as a drop-base rally demand zone. In this trading scenario, what should you do? It's straightforward. Wait for the market to revisit this zone, then establish your long position, set your stop loss and target, and allow the market to follow its course. The second type is known as rally, base, drop. This pattern is the opposite of the drop-base rally. It involves a short upward movement followed by a brief accumulation phase, and then a downward move. The base area within this pattern is considered the supply zone, where institutional traders sell from. When the market retraces back to this zone, it prompts a downward market reaction. This occurs because after significant institutional selling from this zone, they've taken their profits, leading to a market retracement. Once the price revisits this zone, it becomes an attractive selling price again, prompting institutional selling to reap further profits. Let's consider another example. Observing a move upward followed by a small consolidation, and then a downward movement forms the rally-based drop supply zone. Such patterns occur frequently in the market. Mastering their identification empowers you to predict market movements ahead of time, allowing you to adopt the perspective of an institutional trader rather than a retail one. Now, let's discuss the third type, the drop-base drop pattern representing a supply zone. This pattern involves the market descending, pausing briefly, and then dropping significantly. Institutional traders drive the market downward, taking profits during the pause, and then further drive the market down, forming a drop. When encountering this pattern, it's essential to understand what transpired and prepare for the market's reaction when it retraces to test this supply zone. In reality, the market will likely face rejection and undergo a significant downward movement as institutional traders consider this zone an optimal selling point. Recognizing these types of zones enables you to predict institutional trading behavior, allowing you to take similar trades and profit alongside them. Here's another example. The market exhibited a drop, followed by consolidation and another drop. Upon retracing back to test this zone, the market faced rejection, leading to a strong downward movement. These drop-based drop patterns frequently occur in the market. Mastering their identification and trading strategy empowers you to consistently profit across various financial markets. The last type is called the rally-base rally. This signifies an upward move followed by a brief accumulation phase, and then another upward move. It constitutes a demand zone pattern. This pattern frequently occurs in upward trending markets. Essentially, the market ascends, creating a rally, then pauses briefly, forming a base, and finally undergoes a robust upward movement, constituting another rally. This sequence concludes with a rally-base rally formation. When the market retraces to test this zone, it encounters rejection and experiences a strong upward surge. Institutional traders perceive this zone as an excellent buying price, prompting a swift upward market movement upon reaching the zone. Examining another chart example. The market demonstrates an uptrend showcasing buyer dominance. The formation of the rally-base rally pattern signals the entry of institutional traders into the market at this demand zone. Consequently, upon retracement, the market is poised to ascend once again. Understanding how to identify a rally-base rally demand zone in the market allows one to emulate the trades made by prominent market players. If any aspect requires clarification, please leave a comment below. Don't forget to like and subscribe to the channel for updates on our next video. Thank you for watching.